Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Craig Cecilio. Craig is the co-founder of DiversyFund and has been in the real estate investing industry for coming up on 30 years. We had a great conversation today about real estate investing in general and what DiversyFund does. And to give you a quick picture of what we're talking about today, prior to 2012, in order to access quote-unquote private investors, you had to be what the SEC considers an accredited investor, which is basically jargon for a wealthy individual. And if you were not what the SEC considered a wealthy individual, you simply couldn't access private investments. After 2012, there were some regulatory changes that opened up private investments to non-accredited investors. And what Craig and his partner did around that time was create a crowdfunding platform for non-accredited and accredited investors to access private real estate investment deals. And so what Craig's platform does is allows anybody with $500 they want to invest in one of these things to create an account, pop in $500 for an investment or more if you like, and they turn around and pool the money together and buy multifamily real estate, including office and apartment buildings. Craig and I had a great conversation about this. This is not an endorsement of his platform, of course, but he's a really sharp guy. He knows his stuff when it comes to real estate investing, and it was great hearing him talk about the challenges of growing the platform and the business and what he sees in real estate right now. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Craig, welcome to the show. Craig and I have been sitting here chatting about exercise and ice baths and sauna here for about 20 minutes. Craig joins us today to talk about real estate investing and alternative investing in placements. Craig has been running, I won't do your introduction for you, Craig, because I'd like you to describe it in your words. You'll do a better job than me. But Craig has been in the space for quite a while, and he has a tech startup platform. I'll let you describe it here shortly, Craig, that helps non-accredited investors access private placements, particularly in real estate issues. So, Craig, why don't you take it from here? Could you explain to people what that means? Am I way off in my high-level summary?
No, you're perfect, Grant. Thanks for having me. Yeah, so we decided, I don't know why at this point in time, we decided to create a platform to let everyone, no matter what your socioeconomic background, access to private markets. And the first investment product we chose was multifamily real estate. So traditionally, these are institutional grade investment opportunities. Usually it requires anywhere from a $7 to $10 million down payment. Of course, you have to get the bank financing, so you have to have a track record to do that. That's a whole nother story. We could do a whole segment on the bank financing part. And we allow people to invest for as little as $500 today. We're trying to work on that to lower that, but it's very, when you do something new, there's a lot of transactional costs getting it. So now for like the first time ever, because the Jobs Act got passed in 2012 and they passed some regulations to open up the private markets to everyone. So basically, you don't have to be wealthy. You don't have to be an institution. You don't have to be a hedge fund or a family office to participate in these. And I think it's great because with the minimums being so low, you could put a lot of, we have about 30% of our customers come back again and again. So they're micro investing all the time. So it just gives them another tool, another option to build wealth or to balance their portfolio. And especially today, as we talk today, right now, if you had 100 grand in in the stock market, what's it look like? And if you had 100 grand in our investment, what does it look like? And I'm just painting that picture. Use your imagination, because what's happening right now with the stock market's not really beneficial. If you got out in the right time, yeah, it worked out for you. But that's it's good to diversify your portfolio and have that option. And now we're providing that option for people. We have a platform which is a website, and we also we're mobile friendly, and we have an app that's on iOS and Android, and really diving into the technology to allow people this opportunity. It's a kind of convergence of two things: is just the technology and the investment, and bringing those things together. And there's that third part is just putting on those pieces together and working with the ever-changing rules of going on in the world. As you see, another hot topic is crypto and NFTs. What's going on with that today? And it's exciting times. A lot of changes happening.
A lot of changes happening all at once. And if it's okay, maybe I'll paint a picture for our listeners of what we mean when we talk about private investments. So historically, anybody with a couple dollars in their bank account can open a brokerage account somewhere and go and access it and buy a stock or a bond, or these days even a fraction of a stock or a bond, or an exchange traded fund or a mutual fund. And you're buying, let's say you go and buy a share of Apple, you're buying a very small percentage of Apple's, the company. You have a small percentage ownership and a right to vote in the proxies and a right to the earnings that Apple produces each year and each quarter. And that's considered a public investment. You're doing it through the public markets, and Apple has all these regulatory and compliance requirements in order to issue their shares through these public markets that anybody can access, right? Well, there's also this huge market for private investments. And a company who's trying to raise money to grow their operations or invest in real estate, like Craig, your company is obviously doing, historically, if you're going to buy a private investment, you had to be a wealthy person and qualify by what the SEC calls a quote unquote accredited investor, right? And so tell us what happened in 2002 from a regulatory perspective that opened this up to not super wealthy people who are not considered accredited investors. What happened, and why can everybody access this stuff now?
So that's a great question. 2012 came out of the Great Recession, and so I think the administration was the 2012 was a Dodd-Frank bill. That's a Jobs Act, and so they passed this to really increase liquidity into the markets, and really they want to democratize it, allow everyone more opportunities. We just came out of the Great Recession. A lot of people hurt a lot of people. So they wanted to open things up for everybody, give them all more choices, more alternatives and opportunities across the board. And that's where it came from. The government moves real slow because it got passed in 2012. That's when the act got passed. And really, the vehicle we used didn't go to market. The first person, I think, was 2016 to really get that going. And I think in late 15 is when they said, okay, the SEC said, okay, now it's active. You could start applying for it, and everyone started kind of just learning how to do that. Right? There's a whole process to learn how to do that stuff. So it's pretty new, and it's been only utilized in a pretty a bull market because everything's been going up since that time period too. So I'd like to see how it kind of continues to go over the next decade. But these tools were provided to help people, to give them opportunities. One of the biggest things I always say is, like, we always talk about, hey, I don't have this opportunity, or the awareness part of the private markets. And that's because the gatekeepers to these investment opportunities, their motive, who are the gatekeepers? It's usually the brokers, developers, attorneys, very high level people who want to make money at the end of the day. And so for them to make money, the commissions are huge on these type of things. The fees are tremendous in type of things. Do they want to talk to someone who's going to invest $1,000 or $2,000? Because they're not going to charge them a $10,000 bill or a $100,000 commission. So they're not incentivized to educate you or to teach you about this stuff. So that's one of the things that I found quite fascinating, is how much education we had to do about it. So a lot of education about private markets, about the tools we use and how these things work. And we've really had to focus a lot on that. I'd say that's probably the biggest surprise about doing this, is the educational component and the lack of awareness that people have about the private markets and how it operates.
Yeah, it really is a large market, and so if you think back to what was going on in the country and in the world at that time, 2010, 2012, when this legislation was being drafted, this is back post recession, We were on the upswing recovery wise, but this is back in like the Occupy Wall Street days.
Yeah.
And this is, you saw protests all around the country around that. You have bankers, a lot of whom were at least at minimum partially responsible for the financial crisis, right? And so there's this outlash against wealthy bankers and the 1%. It manifested itself through Occupy Wall Street, and now we have legislation that follows that to open up this private investment market to everyday investors. Now, in the reason that to be clear, this wasn't a situation, in my opinion, where the SEC was just creating this vehicle to make wealthy people a lot more wealthy. There are legitimate reasons that it wasn't available to everyday investors, because a lot of these investment opportunities, for example, a lot of real estate deals, you put money into a fund, the manager of that fund takes the money, pulls it together, buys a property, and the idea is they're going to rehab the property and then sell it 5 to 7 years later. Well, it's illiquid, right? If you invest in that fund, you probably can't get your money out until that property has been rehabbed and sold, and it's an illiquid deal. And so in order to protect consumers, that's the reason we had this accredited investor rule in the first place, is my understanding. But now with more disclosure, opportunities, and the way that the Jobs Act was created, to my understanding, it makes more sense to open up these opportunities to everybody. Is that a fair characterization, Craig?
Yeah. I mean, we live in a digital age, and I really promote education is the first point right now. Is everything's out there online for people to self-educate themselves, as long as the algorithms don't get in the way of what they're reading, which we all know that it does.
Which is a problem.
It's all out there for everyone. So I mean, we have to kind of look at these agencies a little differently, and kind of adapt to the modern world. And so there's regulation versus education. And I think we have to focus more on education to the consumer and give them choices. And then I always call it suitability. What is your personalized approach to finance? What is your risk tolerance? What is your personal financial journey? What is your portfolio makeup should be? And understand the difference between growth, spec, and income, and where should that lie. In creating these kind of micro investing opportunities, you don't have to stick all your eggs in one basket, because we were just talking about a lot of these have minimums of 250,000. Most of them have usually 250,000 to do it. So even if you're accredited, you could still be putting too many eggs in one basket per se. And so now with the micro investing, you could say, okay, I could instead of putting all 250 in that, I could put 25,000, or someone else could put 1,000 or 10,000. So it allows you that opportunity to really make sure you have the right amount based on your portfolio, based on your risk tolerance, based on your I call it your personal financial journey.
Right. Which is essentially the same thing as crowdfunding. No?
Yeah. Yep. And yeah, crowdfunding, there's all different connotations to it. I just call it, we aggregate micro investing, because that's what it is. It's small dollar amounts for people. Crowdfunding, there's technical words around that stuff, and I always have to watch out because, got the big oversight gorilla. Really crowdfunding is a segment of the overall Jobs Act, where we use a thing called Regulation A+ for most of our things. And I don't want to get too technical with this, but I can get technical if people had specific questions about those things. So I just like to use we have a platform. We use these tools from the Jobs Act to allow people that opportunity, no matter what your socioeconomic background is. And the other thing I really like about this, and looking from my personal journey of myself growing a business and being in the financial worlds and real estate worlds for almost 30 years now. I can't believe I'm saying that. Is the fact that what you're always taught back in the day, and I'll use these catchwords and you can interpret them, is like, okay, are you looking at the person's car who comes to your office? Or are you asking those questions? And so you're already kind of stereotyping people before you meet them and sizing them up. And being in the digital world, people do it at their own volition. There's no real sleazy salespeople trying to get you something. So you're going either on a website or going to an app to transact, and there's none of that happening. So you kind of do it at your own pace. And that's what I really enjoy about it. There's no kind of, you're not getting that person not talking to you or not getting that service. So everyone kind of gets the same service. So that's one of the things I really enjoy about this is you take that whole element and push it aside that no longer exists. So there's no more stereotyping or anything when an investor comes to the office. It's all done digitally online. So that is another layer of allowing people an opportunity just due to that reason itself.
Right. It certainly levels the playing field.
Yeah.
So take us back, Craig. How did you get involved in real estate investing in the first place, and how did that build toward DiversyFund years later?
Yeah, I mean that's a great question. I know it probably happened. Like it had to happen when I was a young kid. I know it happened because I was always like an entrepreneur. I grew up in the East Coast, raking lawns, doing newspapers, shoveling snow. We had snow. I live in Southern California now, so I don't know what snow is, but grew up shoveling snow, doing lawns, mowing lawns. There's no lawns to mow in Southern California because of drought. So I was always had that entrepreneurial spirit. But I remember like going to college and telling my dad, it's like, could we buy a condo here? It's like $90,000. And he's like, oh, I don't know. It's like, I'll just go in, I'll get a roommate and we'll pay the rent. And I remember that was the first time I was trying to do a transaction. And I started school. I think I just turned 18. I remember I just turned 18 in the summer. And I was a freshman at University of Colorado Boulder. And the property was on Broadway. And, most cities, like if you watch The Simpsons, every city, every state has a Springfield. I think every like kind of city has a Broadway. It's always a good property on Broadway.
It's right next to Front Street. Yeah.
Exactly. Well, that's San Diego is a Front Street and Broadway. Yeah. It's funny. And so today it's worth like probably $2 million, that property. And so that's kind of when I first knew about, okay, I need to get involved in real estate. And so everything else I knew, if I was going to do a job or something, my path is going to lead to real estate. I knew that was something that wealthy people had part of their portfolio. And I was always interested at an early age to do that.
So that very young age is when you got interested in it. How did you dive right into the industry after your time at CU?
Yeah. So, what I did is I got in my car. It was a Jeep. I took it out and I drove it across the desert. I guess that's Nevada and Colorado, and ended up in California. And I moved to a part of California where I had a plan. And my plan was to go my plan was basically become an entrepreneur, maybe go back to school for my MBA, start some businesses, use my income to invest in real estate. And along that journey, within my first year, I met two important people. One was a guy who was doing a lot of condo conversions at that time period. One of the first people, I think this was like 1998 was the year I met him. And then I met someone else who was an attorney that was attorney for people doing syndication, a lot of real estate syndication. And that's bringing people together, almost like crowdfunding today. I learned about syndication in 98, and there's certain ways to do it. And he helped create funds for real estate developers and real estate hedge fund managers. So those are kind of the first two people I met in 98, and they kind of laid the foundation for me to say, hey, this is how you do one side, the real estate side, and the other side is how to do the capital formation, structure, and capital raising. So it was quite an opportunity for myself, and I kind of just threw myself into it and kind of learned everything.
Sounds like a pretty good education. And trial by fire at the very beginning. That's a good way to learn.
Yeah. School of Hard Knocks. It was great though. I was just fascinated. I was basically the kid. I was a kid, definitely a kid back then. Wow, was a kid. But I was like, I showed up every morning. I was like, I don't care if you pay me or not. Everything was commission only. I was like, I don't care. I just want to learn. And for my first year, I didn't make anything, but I learned so much. And I was just kind of dove myself in. I was just a sponge. Like every meeting, every project, I just anything I could learn. I was so happy about that. It was the poorest times and the happiest times for myself during those years.
So when did the DiversyFund come into play for you? When did that idea start festering in your brain?
I read something in 13. I think it was 13. Pretty sure it was 2013. At that point in time, I remember I started a small fund. I think it was 12 or 13 coming out of the downturn. I made a few bucks just kind of buying and flipping homes, and did a couple smaller apartments where I was able to have enough to start my first fund. And I had to put together like a fund pro forma. What's my 5-year schedule with that fund? And I was thinking, okay, we're going to start with flips and do it ourselves and lend money and JV and do all that stuff. And we're going to eventually move into apartments. And then I read something about this, and I was raising money for that fund, right? And I had to do all that stuff. And then I read about the crowdfunding stuff and non-accredited investors. And I'm like, man, this is what I'm supposed to do. And so right away, I was just hooked. I was like, okay, now I could take all like my background of raising capital, and I could do it for everybody, and I could put all the pieces together. And then I already knew what asset class I was going to put it into. Because since I had a plan to put it in apartments, I was like, okay, we're going to do this and put people into apartments, cash flowing properties, a little bit more risk averse than other areas of real estate at that point in time. And just started putting the pieces together, and then the rest was just kind of building the team and just trying to figure everything out. It was pretty Wild West in the beginning days doing things.
So tell me about the strategy with these apartment. Are you still focusing on apartment buildings? What kind of stuff are you getting into today?
Yeah, I mean, we're coming out of a turn of a very frothy market. So everything we've touched is just has done phenomenal. So we're, in my eyes, it's like I'm looking at 2023. I can't believe 2023. I can't believe I'm saying that. In 2024, what's our products? We're kind of pulling in the data, looking at what's happening. We still have a lot of supply chain issues. There's still like low inventory. There's still a lot of government systems. The foreclosure memorandums are starting to be lifted. We want to see how that inventory affects. We've got to watch the evictions, what's going on. You might have high occupancy, but how many people are actually paying? So we need to see how that kind of enters into the environment to affect the supply and demand of product. So we're watching that closely to see what happens, but there's still a very lack of inventory across the country in multifamily, and still trading pretty high. Interest rates have affected it somewhat, but it's still great returns across the board. So you might see a little bit of a slowdown, but I don't think too much. And it's really kind of looking forward and watching that supply. Is there new construction hitting the market? Are we going to have a high level of inventory in that product the next couple of years? But I don't see that really happening in 2023. As we do know, we came out of the pandemic, and then now we have a war going on. So the supply and chain issues, just when you think they're going to get better, they're not going to get better because of that. We'll have to see how that unfolds. But really paying attention. But I really like that asset class. It's something that we are able to source good in good geographic areas with good economic indicators. I believe we could still give solid returns in 2023, so we'll still continue that. And if things do turn in other areas of real estate, we'll be opportunistic to invest in those areas. I got a feeling I think we all know this, the single family market's kind of slowing down. The single family rentals could be a little bit overheated with that stuff, and kind of watching that a little bit and looking at the data coming in. You already can see a significant slowdown. It's almost like overnight it happened, right? It's just like, I don't know.
That seemed to me like it was more impacted by this spike in mortgage rates recently, right?
Yeah. I mean, my neighborhood's just like trading like crazy. I live in, it's still, there's still a lack of supply. That's the thing. That's the big thing, is looking at that supply level. So yeah, I think you see a slowdown in people buying the second homes, right? Because the liquidity is not there. If you're getting a 2 or 3% interest rate, now it's 5 or 6, it makes a big difference for people. They're very payment sensitive. And then if people have more rental choices, it's just, do they, what are their needs and wants? We'll have to look at that closely. But yeah, you're right. The interest rates have affected that and slowed it down. It is slowing down. I'm not sure. We really have to look at the inventory and get those natural supply issues. Kind of with the foreclosures is one of them, and we get the normal chain of events of constructing a property. It's like, okay, are the supplies coming in? What's the cost with that? Lumber's already gone down, concrete's still high, and looking at those costs across the board too. Those issues. But we're in a war right now, so we can't really predict what's gonna go on there. So there's a lot of uncertainty out there, and then of course the political kind of components as well. That's always, I feel like, they kind of pull the strings on a lot of things. If you watch closely, there is a little bit of stuff going on behind the scenes.
So Walk us through one of these transactions. You pool together some money through the crowdfunding like platform. You have the cash. Now it's time to go buy an apartment building. Let's call it.
Yeah.
You're taking the cash. You're probably leveraging it and borrowing some to pay for the property as well, right? Or is it 100% financed or 100% down?
Yeah, no, you get better returns if you're leveraging debt on it. Typically, we're around 60 to 65%.
Okay.
Yeah.
And so what's the intention when you go buy the apartment building? Is it to get in there and rehab it and raise rents? Is it to hang on to it and flip it a couple of years later? Is it to increase occupancy and just draw income from it? What is the strategy typically?
Yeah, so you're looking to buy a distressed asset, and how do you define distressed asset? Is something that's a little bit older that you need to add some work to it? Are the rents under market? Was it mismanaged? Is it in an up and coming area? So you're kind of looking at all those factors before you get in. I'm just keeping it very high level. There's more indicators you look at, and looking at that, and then making sure you're looking at reasonable of reasonable metrics in your underwriting. So to make sure it's like, okay, am I looking at 7% annual growth with my rental rates? Well, that's a little high. That's a little bit, that's if you're in a bull market, maybe, but we want to be very conservative with that underwriting. And so definitely with rates going up, it's going to affect that so much. You want to see, and rents can't go up drastically forever. So you want to be a little conservative with that when you put that into your pro forma. And typically the whole time period, it's anywhere from 3 to 5 years. You're just trying to time the market with that right now. If things do get a little overheated in the market and things do go down, it becomes a good buying opportunity as well. So typically what we're looking at is to sell the properties in a 4 to 6 year time period to time the market with that. Right now we're in a situation where I think we've sold. This year we'll end up selling like close to 5 properties because it's pretty frothy. And there's some amazing returns. And I can't say we'll get those in the future. We'll always try our best to get higher returns, but it's pretty incredible. It's like I haven't seen it before take off like that. So we had a good run with that. So we'll just be careful going forward and look at those leading indicators of, hey, what's a good area? What's the patterns of people moving into those areas? What's the job growth in those areas? What are those economic indicators of specific markets? Geographically, we're throughout the U.S. Of course, like everyone else, the Southeast is where we're heavily concentrated right now. We're always looking at any other emerging markets as well.
Right. So does it ever make sense just to hang on to one of these properties and draw the income off of it? Or is it always a better route to maximize your returns to liquidate and then return cash at some point?
Yeah, so it gets complicated with us because we have 30,000 investors right now, and so it's just really kind of improving and delivering a product to them and listening to their needs and wants with that. And as we grow, we start thinking, okay, can we keep these properties? So that's something that we're looking at doing long term if we can. And that's a great thing is if you have 2 or 3% debt on these properties, why do you want to get out of that? That's phenomenal, right? So in some cases you look, okay, I might hold some, and we'll look at that. We'll look at both sides for that. For us, some of them we want to sell, go full cycle with them. It's good for a portfolio to good look at that, to be opportunistic and sell once in a while. If I had to live in a perfect world, unfortunately, some of these offerings that we're doing through the exemptions or regulations, the funds are small in size, 50 to 75 million. So sometimes it doesn't pencil out to do it that way, but we're looking at kind of changing that and seeing what's coming down the regulation pipe, if we can make those funds a little larger. We've kind of moved into that level where it gives us more options to do those things. When you're relatively small, it's hard to do those things with the smaller funds.
Right. So you have 30,000 investors, let's compare that to say you talk to 2 or 3 really wealthy people. Those 2 or 3 people pool the same amount of money together, and then you go buy properties for them. As the world materializes and the opportunities for driving value in the property and then maybe exiting kind of materialize and come to fruition,
Yeah.
you have to report back to these 2 or 3 investors. What is it like reporting to 30,000 investors and learning to their needs to drive your decision-making within the funds? How do you handle that?
What's called WIP, work in progress.
Yeah.
So this is where you get in more the tech side of things and the startup world type of things, where you have the user experience and the customer experience and building out your app and giving push notifications and giving updates, doing customer interviews, and really drilling that process down, creating chats, creating access to stuff, giving reports, giving transparency, doing all that stuff, creating technology stacks, connecting all your components of your business with each other, trying to make all the areas efficient as possible for them to give them a great experience. It could be just making a graphic a little bit better. It just explains something. So maybe some people like to read a statement. Maybe other people like to read a graph. Some people want to deliver via email. Some people want it to go into the app. Some people want to log on a website. So it's basically how do you kind of do it all? Because you want to, again, I go back to that personalized journey, and each person wants to feel like they are the master of their own journey. So you want to give them that experience, since that's when we get the data. And data basically means saying, hey, what do you like? And try to deliver you that information that way. And that's where the technology comes in, because you could, if people give you that information, how they want that information delivered, you could create with technology, you could deliver it that way that they want and personalize that for them. And that's where that's kind of the startup and technology and product come into this. And you think it's easy, but that's where the significant costs come in to get the machine going. And then once you kind of get it going, you're always constantly improving that feedback mechanism. And what's great nowadays is every second there's a new piece of technology being created. And so you can just, it's moving so fast to make that experience much better for everybody.
Right. So what does your communication cycle look like then? And I don't intimately understand, but I understand that you do have some kind of requirement to report back to holders of the fund how
Yeah.
things are going and what's going on. What does that look like when you're communicating to 30,000 people through the app using the technology?
We're constantly doing updates. So anything significant event, we'll send an email out, we'll post it, do a push notification, whether we're purchasing a property, whether we hit a milestone in the renovation, whether we hit a significant goal in accumulation of capital, deploying capital, if we sold a property. So anything that has a significant impact upon their investment and upon the company itself, for sharing that information with them. Since we are a private company, but we're publicly registered with the SEC, we do have to file with the SEC and audit our financials on an annual basis. And that is perfectly fine to do, because that allows transparency. And for those people who really want to dive deep into their finances, that is public information. You could go on the SEC's website and dig into those financials. So all that stuff is available for people. And then for us, there's always the compliance world, is because we'd like to summarize stuff. We're always kind of trying to figure out how to do it to stay in compliance. You got two sides, the compliance side, and then you got what the customer wants, and trying to always, and I call it test it, and always testing it and making it better. I got a little acronym, I call it do, learn, grow. So we're constantly doing things, learning from it, and making it better and growing from that. And so as long as we keep that up, the customer always gets an experience. And granted, 30,000 people, it's you're not going to make everybody happy, but our intent is to make it better for everyone.
Yeah. We have a similar concept. I call it ready, fire, aim. And same idea right there.
Yeah.
You got to jump into it first and then learn from the experience and then, move on. Another question I had for you, Craig, was, so in my financial planning practice, when I hear somebody come into our office with a non-traded REIT, and so before the crowdfunding was used for these, there were a whole lot of private investment opportunities in this big market that we're talking about.
Yep.
Through real estate investment trusts. And those types of investments have kind of earned a bad reputation over the years, because a lot of them were sold with a massive commission to the person, the representative who would sell it to the end client. And a lot of them just evaporated. There was either fraud or embezzlement somewhere along the chain of people touching the money, or there just wasn't any transparency whatsoever. And more than, this has happened pretty frequently over the last decade that I've been doing this. Somebody will come in with one of these non-traded REITs. They were sold it from a representative that just kind of rammed it down their throat. They didn't understand what they were buying. It had illiquidity, right? Because as we're talking about, you get into one of these deals, it has a 3 to 5 year turnaround time. It can be great, a great way to build wealth. But if you don't understand that time horizon in the first place, a couple years down the road, you're kind of stuck wondering what the hell you have and how you get out of it. And it's been a bad experience for a lot of people. Now that you're able to use the crowdfunding and the tech to offer smaller investment increments to a much larger number of people, you have an audited financial statement by an objective CPA every year. Do you run into pushback from that? I mean, it's from my seat and financial planners that I speak with, I can't tell you the ratio of good experiences with non-traded REITs that we run into to bad experiences is very, very low. It's like 9-1. People are usually not happy with the outcome of their non-traded REITs as opposed to those who are happy with the outcome.
Yeah, communication and transparency are the key. But I think the key is like when you buy a good asset, no matter it's real estate or something else, the whole key is like, how are you acquiring that, right? So am I acquiring the right property? Am I acquiring the right asset at that point in time? Okay, and so when you look at that, you have a business plan. Am I matching my business plan? So I'm kind of unpackaging this here. So if I'm acquiring a customer and that customer is going to put money in, what is that customer's goals? Does they match my investment do I have for that? So that's where I go back to like the personal journey and the financial planning. And so, okay, since we have these low minimums, most people, 500 is nothing for anybody. So if you're complaining about 500, how many people have like TVs? Everyone's like 4 or 5 TVs, right? So what's $500 at the end of the day? So it's really an inconsequential amount of money. What are your financial goals? And does this instrument, this vehicle match your financial goals? And really have that communication up front with everything and then having transparency throughout that process. And that's something that, again, it's constantly improving that again and again. It's like repeat, rinse, repeat, rinse, repeat, rinse until you perfect it. The tough part, like you said, you could have a negative experience with some things. We're fortunate, and I'm not saying it's a lot of hard work to be at the level now, almost over 5 years of having the company. We built out a sizable audience that we're able to do that, and we have a big enough staff to consistently do that. But it does take I don't want to say a Herculean effort, but it seemed like it did because a lot of the stuff was thrown at us during this process to put that together. But now we are, and so we're kind of optimizing, always getting that feedback mechanism going. And as we go, we add more tools. Now we're a registered investment advisor now, so we're able to do more things with that. Down the road, what other things are we going to introduce into our company to benefit the customer? And again, I think we talked about earlier, we're in the digital age. There's a lot of stuff out there with information, but there's also misinformation as well. And I think you said that so we're not selling people our whole workflow. You're not talking to anyone at all. We don't talk to people. There's a variety of reasons. One is what I said before. I don't want any of those sleazy salespeople. It's very hard to have oversight over there. We want a lot of people to do this at their own volition. So we do that. We have customer support, but we don't do sales for people. Those are two different things. And by doing that, you don't have that pushy person putting someone else in. You allow you to be the master of your own journey, per se, on that. So again, we're constantly optimizing it, making better, and that's all you can do. And also I like competition. I like having other people in the market. I mean, fortunately, there's not a lot of competitors out there because it's just really hard to get to these levels. And is having the environment of having multiple companies out there so we could push ourselves to be better, so you can choose the best service you want for that. But that just pushes us all to be better across the board, to get our service better, to get our experience better, transparency better, and see how that works at the end of the day. But yeah, there's a lot to it. We've gotten there, and our thing is, one of the things I say, we like to serve our investors, and so we have that customer-centric mindset. Is how do we make it better for them? Because we make it better for them, which is the transparency, the experience, the communication, of course, the return. We're going to have, like you said, we'll have positive feedback, and we'll get more customers.
Yeah. So let's say somebody pops over to your website, creates an account or a profile, and puts $500 in to get started in one of these things. Are you, through the website or the app or whatever mechanism they're using to put dollars in, are you collecting their information about their time horizon and objectives and all of that through the technology?
There's a little bit. There's some questionnaires being asked in the process, and as we grow, we'll be asking more and more questions and fill in like your profile a little bit more later on with that stuff. And we're pushing a lot of articles and content towards people, so it does ask some questions about your financial goals. I think we have 4 or 5 questions that does ask through our workflow today. And as we grow, we'll be asking more and more questions for people. I would say that the biggest thing out there is just the educational component. Is just letting them know a little bit how this works. The multifamily asset is there's a lot to it, and it could be confusing for people. So we did about 1,000 customer interviews, and it was crazy. Like the number one thing is, and no matter who it was on your educational level, it was still the same type of feedback, was not really understanding of how it works. And so we're constantly testing it and trying to make that better for everybody. But I was a little shocked by that. We had people with CFA licenses not even understanding this stuff. And that was a little bit, it was not only concerning, but it was a shock to me. And I think a little bit for myself, being around for almost 30 years in the industry, it's more, I like talking to my employees, my new employees. Do you understand it? Because if they understand it, I know my customer understands it. So it's kind of educating everybody about this across the board. Almost like I'm been around too long, so I just say stuff and I'm like, it goes over people's heads. So we're constantly just trying to work on our communication, our messaging. Again, how do we deliver that stuff? Is it video? Is it an infographic? Is it an article? Is it a blog? What is it? Is it a seminar? Is it, a video? Is it a interactive one? So we're doing it all. And that's all we can do, and try our best to educate people about it.
Sure. So if even though the denominations might be small, you said, $500 is like a TV.
Yeah.
Have people attempt to get their money back prior to the completion of these deals? Is that doable?
Yeah, you do have people call in, and we do it on a case-by-case circumstance if there's some kind of significant event in your life. But it's not designed for that. So it's, again, asking the questions up front, educating them about that. Like if you really want to balance your portfolio and really kind of invest in a growth investment, you got to allow it to mature and appreciate. So by you doing that early liquidation, you're really preventing yourself from getting that return. So it's got to be some dire circumstance. And as we just talked about earlier, if you're talking $5,000, $1,000, $5,000, then going into that investment, you have to look at your financial situation, because if you're pulling that out at the end of the day, I mean, you're in something's wrong, right? So there's something significantly wrong with you financially. So maybe you got to get your finances sure first before you start investing. We came out of a crazy time period where people are just investing left and right, and chasing. I don't want to go talk about crypto because it was like this. Now it's like this, and I'm not sure if you're following Coinbase either. So there's a lot of stuff going on there with that stuff. But, a lot of people, it's not like you stick $500 in, it's going to become $5 million. It's not like you're buying Shiba or some other cryptocurrency. So we just got to make sure and communicate this. This is more tried and true. It's established. You're not going to have the fluctuations as much as the stock market. It's not speculative investment, and just educate people so they understand it, and just keep doing it. It's like repetition. It's like, again, nonstop.
So you mentioned that you have the tech, the platform in place. Right now, you have a pretty consistent strategy of multifamily, and that's about it, right? Expanding into other geographies. What's next in terms of offering new and different strategies? Seems like you have the platform in place. Why not pursue some other avenues laterally in addition to expanding geographically within multifamily?
Yeah, we'll be opportunistic. We'll look at where the market's headed. I like to be a buyer in a downturn, so we'll see there'll be some low-hanging fruit, which means maybe some short-term investments you could pick up at discounted, and some opportunities come along. We're starting to see some stuff come our way, and we'll take advantage of that stuff. To process drive it and to scale it is something different than just this one asset. We can keep this asset going for a long time. It's tried and true asset, so you just got to be careful with that with market cycles. So and when it's down, when you buy something at a steep discount, it's really hard to I'm not going to swear, but it's really hard to screw it up, right? Because you're buying it so low and it goes up. But when you're buying stuff in a frothy market, there is a lot of room for error. And so I think that's what you're seeing right now. Things get hyper scrutinized on things with that. So we just want to position ourselves well to be opportunistic. We're looking at the data. We have a mechanism, a platform set up that we have liquidity, and that's the first name of the game is being liquid. That's the reason where the everyday investor doesn't have the opportunity. They're not liquid enough to take advantage of these downturns. And every single downturn, who makes money? The wealth gap just gets bigger and bigger and bigger, and it just repeat rents. 2008, right? We just went through the pandemic. Tons of people made money, but how many people did it really filter down to all levels? Do we have? I don't have stats. Do we have stats in the middle class? Has it shot up? Is it shrinking? What we're looking at that, and that's the thing is now we have a tool. So if when it's happening again here, is that we could have people be able to benefit from those terms where they're not able to benefit before, and it's always about having. It's having the capital on hand. And so you might not have $100,000 or $1 million to do it, but now you could do some micro investing and make a few bucks. So that's really when you knock it out of the ballpark, because during those downturns, if you're liquid.
How do you think about the timing of the life cycle of these funds? And I was checking out your website before we jumped on today. It sounds like you have one fund that's open right now. Yeah. And you mentioned being opportunistic when there are, when cap rates are a little bit higher and prices are a little lower, wider margin for error, better ability to produce returns for investors. Does it make sense to collect money from investors now and sit on it waiting for those opportunities to come up? Or do you really need to wait for the opportunities to materialize and then turn around and collect money from investors?
Depends on your business plan, how you operate. We're constantly, transacting on a daily basis, 24/7, since it's all automated. So we're always deploying stuff. We always have opportunities come our way. I think we'll be close to, if we hit our goals by the end of the year, maybe $500 million under management of real estate. So it's big, but it's not that big. It's not in the billions range, and we have a system, we have a strategy in place that we're always able to recruit it and deploy the capital in a timely manner. So we don't have any questions or concerns over that. And there is a lot of opportunity out there still. We do still have opportunities. And that's kind of the history of just being in business for a while and having the relationships. And that's another conversation too, because the gatekeepers know us. They know we could close a deal. And so we get first look on a lot of things. We've built that track record. And that's a big thing. If you're just a regular person and trying to get going with these things, you don't have that opportunity. And even if you're going and you are doing this as a career, and you are a real estate developer, where are you in your life cycle? Are you getting those first looks, or you're getting those last looks with things? Because once you build a track record with the top gatekeepers, you get first look at things, and that takes a while. And so our organization was able to build that up over the last decade or so. So,
yeah. And by gatekeepers, you mean brokers representing sellers as new opportunities come to market. They're calling you first because they know that you can close a deal, right?
Yeah, it's the game, right? It's the brokers, dealers, gatekeepers. It could be when people know who you are. It's like you could have a property manager at one state. Oh yeah, they represent us, someone who owns. That's like, oh yeah, maybe I'm thinking of selling. Oh, check these guys out. They buy stuff, and you start trickling down to all levels of the industry, and them starting to refer your off market stuff.
Sure, yeah, makes sense. So as we wrap this up, as you look to continue growing and scaling the fund and the platform and the company, what's the hardest part about it right now?
Obviously, the changing I don't want to say political environment, the changing environment. It seems like things are changing so quickly. So it's being able to move an organization that's getting larger and larger all the time, and with a dynamic external world. So that's always a challenge. So it's not like when there's a few people, it's easy to do it, but when you have a whole vast army of employees and partners to move that stuff, especially when right out there in the world, there's a lot of stuff, technology and compliance in the markets are all just so dynamic in the way they change. You could see that with the regulatory agencies and how they're coming down hard on NFTs and cryptocurrencies. How does that trickle down to everything else? Usually to me, myself personally, compliance means more costs. So it means I have to add more staff or more attorneys to figure that stuff out. And so those costs usually get drilled down to the consumer. And we're supposed to be applying technology to make the costs go away. So how do we balance that out? That next challenge is if there's more regulation on every stage, because we take people's money, we have to transact with money, we have to file these things publicly. And so you have attorney costs, auditing costs, accounting costs, transaction costs. You have all this technology out there. That's great. That's supposed to offset it. But then if they add another layer of compliance, there's more costs. So it's always that battle, because I'd love to get the people to come over and lower the amount for people. So you can do a lot of different things and have people maybe have the money come out of their paycheck on a biweekly basis. But to do that, we have to make sure that the costs make sense for all parties. And all parties, you want all stakeholders. And that means everybody involved benefits at the same time and being more I don't want to be a shareholder specific company. I want to be more a stakeholder. That means my customers, my employees, and my shareholders are all aligned together to help people out, and not one person's taking more of the pie than the next, that we're equally sharing amongst everybody.
Right. And on a growing ship, it becomes harder and harder to steer that ship to a new direction, as you put it. That's an ongoing challenge.
Yeah, it is.
Well, what have we missed, Craig? This has been a great discussion.
There's a lot to talk about, but we hit a lot of things. I think that's a lot for people to hear, for your audience. There's so much to talk about. I could talk about so many things, and the journey to get here was a great story as well. But just stay tuned to see what's next. I'm excited. So I love these times.
Well, I'm excited for you. You've got a very cool platform, and I'm looking forward to seeing what you do with it. For people who are interested in learning more about your fund and what they can do to sign up, where should we direct them?
Yeah, easy. The platform, DiversyFund.com. We're also on Apple and Android. You can easily download the app. My social channels are Craig Cecilio and CXC for my middle initial. So you could reach me there. And I'd love for you guys to try us out and check us out. It'd be fantastic.
Are you an Xavier? Is that the middle name?
Xander, yeah.
Xander. Unique. Very nice. And DiversyFund, DiversyFund?
That's it, yeah.
DiversyFund with a Y.com. Very cool. Well, Craig, thanks so much for being on. This has been great. It's great to meet you, and I appreciate your time.
Great. Thanks, Grant. Appreciate it.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.